Good day, welcome to today's class. If this is your first time on this channel, please click on the red subscription button, and if you are a returning subscriber, I say thank you and God bless you. So in today's class, we'll be treating a very interesting topic in cost accounting, which is called the cost volume profit analysis. Now, what does this topic deal with or is talks about in a nutshell? These topics help us to determine which quantity are we going to produce to make profit. Yes, for example, I'm in a business and I want to make a profit of $1,000. So how many quantity can I produce to make a profit of $1,000? How many quantity can I produce that if I, even after paying tax, I'm going to make maybe $300? Or so it is used, this topic majorly is deals with profit, sales and cost. So it helps in decision making a lot. We use it in decision making. So I will start with explaining some important terminologies, then from there we move deeper and we start taking questions. So the first terminologies I would love to deal with is what we call contribution. Now, something about me is that I don't just like giving formulas to students. No, I will love to explain, break it down, understand why it is like that. So I want you guys to follow me as I'll be breaking down each and every of this topic, or these formulas rather. So what do you mean by contribution? Okay, now there's something we call, let me start with break even before I even explain contribution. There's something we call break even point. Yes, what do you mean by break even point? Break even point is a point where a business is not making loss and a business is not making profit. Yeah, what do I mean by a point where a business is not making loss and it's not making profit? That means that the total cost of production is equal to their total revenue that they generate. So at any point in time where my total cost is equal to my total revenue, I will say my business has break even. But you should know that as a business owner, you will aim above breaking even, because you cannot just say you want all the costs, all the money we've put in your business, you just want to have your money, you don't want to have any profit. It's not possible. So break even is just the point where our total cost is equal to our total revenue. That is just what we mean by break even. Now let's come back to contribution. So I will borrow this formula of break even to explain contribution very well. So that is break even. So break even at any point where total cost is equal to our total revenue. Now I'll borrow the formula of break even to start contribution. So break even is total revenue is equal to my total cost, right? But you should always know that there are components of total cost. Yes, total cost has components. And what do I mean by components? Total cost is divided into total fixed costs and total variable costs. What do I mean by total fixed costs and total variable costs? For example, consider this board I'm using to shoot this video now. If, for example, I bought this board for $1,000, and when I bought it, I only use it for once a week to shoot a video once a week. So as time goes on, I started using this board every day to shoot videos. Do you think it will ever make the seller or the person who sells this board to me to come and meet me and say, you are using this board for too much now, or for too long, you have to pay more money? Is it possible? It's not possible. It's not reasonable. So the cost I use in purchasing this board is a fixed cost, because whether I shoot one video or I shoot more videos, I do not shoot video at all, it does not affect the price. So fixed cost does not change with the level of output. Whether you are increasing your output or you are reducing your output or you are not producing, fixed cost is constant. That is why it is called fixed. So on the contrary, on the other side, we have variable costs. So let me note it down. Total revenue is equal to total cost can be divided into total fixed costs plus total variable costs. So total variable costs, on the other hand, are costs that changes with the level of output. And a good example is the marker I'm using to shoot this video. Yes, when I was shooting one video a week, maybe I only use one marker for a video. But now I want to be shooting 2, 3, 5 videos a week. I have to use more than one marker. So the rate at which I consume marker is dependent on how many videos I'm shooting. So that is a variable cost. It changes with the level of package. So you need to know that the total cost is divided into total fixed cost and total variable cost. But you should know very, very well that as a business owner, as an entrepreneur, you will not pray to break even. You will aim higher, aim for something more than breaking even, because at this point your money you are making is just equal to your total cost. You are not it's not, we are not fascinated, it's not interested. We want to make profit. Here now there's no profit. So if I'm to be making profit, my total revenue must be greater than my total cost. Do you accept that? Like if I'm making profit, if my total cost of producing a marker is 100 naira and I want to sell it, if I want to make profit, I have to sell it maybe 150. So the 50 naira on it is my profit. So my for if profit is now involved, my total revenue will be equals to total fixed cost plus total variable cost plus profit. Yes, because my total revenue is my total cost plus profit. TFC and TVC are the total cost plus my profit. So now, what do you mean by contribution? Contribution is simply your total revenue minus total variable costs. Yes. The formula for contribution is total revenue minus total variable costs. Now, from this equation that is above, my total revenue minus total variable cost will be equals to my total revenue. If I'm bringing total variable cost to this side, it will be TR minus TVC equals to TFC plus profit. So, in a nutshell, T total revenue minus total variable cost is equals to TFC plus profit. You see this formula we have on the board is the formula for contribution. And let me explain what contribution is. Contribution is just that, the amount that is dependent on how many videos I shoot is my variable cost. Because if I don't have variable cost, I cannot shoot. If I don't have marker, I cannot even shoot. Do you get what I'm trying to say? So my total revenue minus my total variable costs will give me the amount each of my cost of production is contributing for my fixed asset. Let me explain what I mean. Let me give you a real life illustration. Look at this board now. Let's say I bought it $1,000, and this marker I only spent 100 naira in purchasing one marker per video. So let's say per video lecture I'm selling it for 500, and I'm only buying marker of 100 naira, and I'm selling video lecture of 500 naira. So I'm making my 500 naira per video lecture minus the cost of one marker, which is 100 naira, will give me 400. That 400 is my contribution. So it is in that 400 that I have my fixed cost and I have my profit. Because if you look at this equation, when I subtract total revenue from total variable cost, I'm having my total fixed cost plus your profit. So whether you use the left hand side of the equation or you use the right hand side of the equation, that is the formula for your contribution. So your contribution is equals to total revenue minus total variable costs. So we've established that my contribution is equal to total revenue minus total variable costs. Yes, total revenue minus total variable costs. And this is in total. If you want to express it in units, just divide everything by quantity. Divide this by quantity, divide this by quantity. So your total revenue divided by quantity is your sales in units. Your sales, the amount you are selling one, minus total variable cost divided by quantity, that will be variable cost per unit. So whether you use the formula in aggregate or use the formula in units, it's still the same thing. And don't forget that another formula for contribution is also fixed cost plus profit, because on the other side of the equation I explained earlier, if you collect like times total revenue minus total variable cost, you'll be left with fixed cost plus profit. So this is the formula for contribution. So let's establish more formulas and that we will use in solving this question. So Now the next thing we are going to be established, or the next formula we are going to establish, will be from the break-even formula. So don't forget that it's from the break-even formula we also establish our, what's it called? We establish our contribution formula. So sorry, let's establish that formula. So now from our break-even, which is also total revenue equals to total cost. Now, whenever a business breaks even, their total cost, total revenue is equal to their total cost. Good. And don't forget that their total revenue is also, we can break this down by saying the average fixed, total fixed cost plus total variable cost. Now, to get what I'm trying to say, and don't forget that at break even, total revenue is equal to total variable cost, right? So I can bring this total revenue, total variable cost to this other side. So I'll be having my total revenue, total variable cost, bring it, minus total variable cost equals to total fixed cost. What does this mean, or what does this formula implies? This formula implies that, don't forget that I've established the formula for contribution, that my total revenue minus total variable cost, from what I explained earlier, is my contribution and is equals to my total fixed cost. So definitely that means that at the point of break even, my contribution, which is total revenue minus total variable cost, is equals to my total fixed cost. So that is what it means. So we can say contribution is equals to total fixed costs, because that is what the formula implies, that my contribution is equal to my total fixed cost. Now we can, let's do something to this formula. This contribution is total contribution, and fixed cost is total fixed cost, total everything, and contribution is total contribution I derive from all the goods I've produced. I can break this contribution down by saying contribution per unit of one product multiplied by the quantity equals to my what? Total fixed cost. Yes. If I'm making a contribution of 100 naira from one product, then, and I produce 10 products, then definitely my contribution, total contribution is 1,000, because 100 naira from 100 naira contribution from a product and times 10 products, which is 1,000. So contribution per unit, which is 100 naira, times the 10 quantity, will give us me what? The total fixed cost. So from here, to get the quantity that break even, I can say divide both side by contribution per unit, divide both side by contribution per unit. So therefore contribution per unit cancels contribution per unit. The quantity that breaks even is equal to total fixed cost divided by contribution per unit. So this is the first formula I'm going to be using, or I'm going to establish, is that if you want to get the quantity that will make a business break even, is equals to your total fixed cost divided by contribution per. So that is what it implies, that if I want to get my quantity that will break even, is my total fixed cost divided by the contribution per unit, contribution in unit. So let's establish another formula. So don't forget that the formula that we derive here is the formula for the quantity that will break even. So if you want to get the break even in values, yes, in value, that means in monetary value, what are you going to do? You can simply multiply whatever you get here times 100. So by saying in value, break even point in value, break even point in value will be total fixed cost divided by the contribution per unit, contribution per unit times selling price. So this will give you your break even point in value. That means at the point where you break even, what is the value in money? That is what it means. Or if you don't want to use this formula, there's another formula that you can use, and that is simply total fixed cost, total fixed cost, total fixed cost divided by contribution, contribution to sales ratio, contribution to sales ratio. Yes. Now, if you don't want to use this formula, which is total fixed cost divided by contribution per unit times selling price, to get your break even in value, this formula straight away will give you your break even in value. Don't worry, when we start to solve and we connect all these formulas together, you will understand. So the formula is total fixed cost divided by contribution to sales ratio. So how do you get your contribution to sales ratio? Is very simple. From the way the formula implies, it is contribution over sales. So the contribution per unit over the sales per unit. Then if you divide your total fixed cost divided by it, you get your break even point in value. So that is that about that. Let's establish other formulas, then we take questions. So the next formula we establish in this video is the formula whenever we have a targeted profit. I said it earlier that break even point is not enough. The quantity that will break even is not enough. Rather, we need to make profit. So for us to make profit, we need to know, if I want to make a profit of 200,000, how many quantity should I produce? So in that case, it's quite related to your break even formula. So which is your total fixed cost divided by, you divide your fixed cost by contribution per unit. But not just your fixed cost, you will add your targeted profit to it. Targeted profit. So you will increase your fixed cost by your targeted profit. So it will give you the amount that you will sell to make a targeted profit. So your fixed cost plus your targeted profit divided by contribution per unit. So another formula we are going to establish here is targeted profit in value. Yes, if you do this, you get the quantity that will give you your targeted profit. So fixed cost, just a normal formula for break even, but now you're adding your targeted profit. And the idea for this formula is just that increase your fixed cost by your targeted profit. So if you want to make 200,000, increase your fixed cost by it, so that the quantity you will produce will cover your fixed cost and at the same time cover your targeted profit. That is just what it implies. So now in that situation, this is my quantity. So targeted profit in value. If this formula will give me the quantity, so it is just multiply it by 100. Multiply it by selling price to give you your targeted profit in value. That's just it. So all these fixed cost plus targeted profit divided by contribution per unit will give you your quantity. Then you multiply it by the selling price to get the amount in values in monetary terms. So that is that about. Another formula we have here is the formula for margin of safety. Yeah, margin of safety in units and in value. What do you mean by margin of safety? Let's say 100 quantity is what I will produce to break even. If I produce 100 quantity, I will break even. Definitely, if I produce 80, 70, 60, I'm going to be running at loss. But if I produce 120, anything above 100, 150, 300, I'm going to be making profit. So the margin of safety is how safe you are from the break even, because it is the break even point that separates your profit from your loss. So margin of safety means that how safe am I from the break even point. So if I'm producing 300, margin of safety, this is it. So margin of safety is whatever you are producing or targeted sales. Margin of safety, margin of safety is my budgeted sales or budgeted quantity sales minus break even sales in value minus break even. So the point at which the business is the quantity at which the business is producing minus the quantity that will make them break even is my margin of safety. And the last formula we are going to establish in this video, then we are going to take questions and solve, is the one of net profit after tax and net profit before tax. Yes, what do you mean by net profit after tax and net profit before tax? Net profit after tax means that you are paying tax, yes, which most of businesses in Nigeria do. Most formal businesses, I mean, not informals. So you are paying tax, and with your tax, you know that government will tax you if you are paying tax. Yeah, government will tax you. So you want to make a budgeted profit of 200,000, and you know government will tax you from your profit. So if you want to make 200,000 in profit and government will tax you, then it is no more 200,000. Do you get it? So what is the formula I can use that even if government apply the tax, I will still get 200,000 profit? It is still related to your break-even analysis. It's just fixed cost plus your targeted profits. Targeted profits. Now, if the targeted profit you want to make is after tax, that means that if government tax me and after paying the tax, I still want to have 200,000. That is what I mean by target profit after tax. You divide it, your target profit after tax, you divide it by 1 minus the tax rate, everything over the contribution per unit. Now listen, the formulas are not hard to understand, but the moment we start solving, you will get it right. They are not hard. So the fixed cost plus target profit, but if it is after tax, I repeat, if it is after tax, you want to make, after paying your tax, you want to make a profit of 200,000, then you will divide it 1 minus tax rate divided by, don't worry, when I want to solve, I will explain why we need to divide when we have gotten to the question. I don't want to make this video bulky. So, but if it is target profit before tax, that means that I want to make a target profit of 200,000. I don't care whatever tax I'm paying, but I just want to make a profit of 200,000 before I even pay the tax. I want to make a profit of 200,000. Then if it is before, you will now say fixed cost plus targeted profit multiply by, now you will not divide, multiply by 1 minus tax rate over contribution per unit. So it is different if it is after tax. You want to make a profit of so amount after paying your tax. You want to make a profit of 200,000, you divide it, the targeted profit, by 1 minus the tax rate. But if it is after the tax, before the tax, you just want to make 1 million naira, whether you not pay tax of 200,000, you don't care, but I want to make 1 million naira as profit. So that will be 1 minus the tax rate multiplied by the target profit divided by the cost contribution per unit. So if you have any part of this video where you don't get anything right, please go back and watch it again where I've break it down and everything. You will get it right, because in my next video class we'll be taking a question and we'll be solving it together. See you right there in that class. Remember to subscribe to this YouTube channel. Thank you.